Hello all, welcome you to another session on our value investing series. Today actually it's a follow-up session. If you remember our earlier session number 73, Alchemy of Finance by George Soros. So there I had told there are thinking participants in the market, in the stock market and other markets, and the thinking of the market participants actually have a reflexive relationship with what is actually happening thereafter in the market. So the market fluctuation and the participants thinking and active participation in the market buying and selling, the reflexive relation between them was very well explained in that. If you have not watched that video, then I strongly recommend you to watch that video and then watch this video. So at that time I had mentioned that I will give you a step-by-step procedure by which you can do a reflexive analysis of the particular stock or the market you are analyzing. So as promised, here we are again with a session wherein we will be further decoding the reflexivity analysis of stocks. Again, I take all the content of this video from the book Alchemy of Finance, which is actually the thoughts by Mr. George Soros. So let's get directly into the topic. So let us build a simple model of boom and bust cycle, which is the up and down curves inside the market. So always we have to start with an assumption. So let's assume that you don't know the underlying trend as of now. The underlying trend is not yet recognized. Also, the prevailing bias is not yet reflected in the stock price. So say, let's assume it's positive prevailing bias. So when the market participants recognize the trend, this change in perception will affect the stock price. So this change in stock price can affect the underlying trend in two ways. So case one, it may affect the underlying trend. On case 2, it may not affect the underlying trend. So case 1, we have a beginning of a self-reinforcing process. The enhanced trend will affect the prevailing bias in one of the two ways. First one, it will lead to the expectation of further acceleration. In the sense, the stock prices goes even more high. Or it can lead to the expectation of correction. So these are the two cases. In case of expectation of correction, the underlying trend may or may not survive the correction in the stock prices. In case of expectation of further acceleration, a positive bias is developed, causing further rise in the stock price and further acceleration in the underlying trend. So if you see this underlying trend, prevailing bias, positive bias, all these things are very well explained in my earlier video of Alchemy of Finance session 73. So I repeat, this will be too much complicated for you if you have not seen that video at least 5 times, because the book Alchemy of Finance, as I told, is a very complicated book with a very tough concept. So I have decoded that entire book in that session 73. So please go watch that. Then only I recommend you to watch this video. Otherwise, you will not understand the thing. So as long as the bias is self-reinforcing, the expectation of the market participants, that is the investors. So the expectation rises even further or even faster than the stock prices. The underlying trend becomes increasingly influenced by the stock prices. And the rise in stock prices increasingly become dependent on the prevailing bias. So the underlying trend and the prevailing bias becomes increasingly vulnerable, and eventually the trend in the prices cannot sustain the prevailing expectations of the market participants or the investors, and a correction sets in the price of the stock. So these disappointed expectations have a negative effect on the stock price, and hence the falling stock prices weakens the underlying trend. If this underlying trend becomes overly dependent on the stock prices, the correction may turn into total reversal. In that case, the stock prices fall, the underlying trend is reversed, and the expectations falls even further. In this way, a self-reinforcing process gets started in the opposite direction. Eventually, the downtrend also reaches a climax and reverses itself. Typically, a self-reinforcing process undergoes a orderly correction in the early stages. If it survives those corrections, the bias tends to be reinforced and is easily shaken. When this process is advanced, correction becomes scarcer and the danger of reversal is greater. So the fundamentals of the stock includes earnings, dividends, asset value, free cash flow, etc. So these are the fundamental yardsticks. It is quite possible to have a reflexive relationship between stock prices and the prevailing bias, even if the fundamentals remain unaffected. So if you see, without these fundamental yardsticks like free cash flow, asset value, and other earnings yield, etc., not involved, these fluctuations, up and down fluctuations, can be really short-lived, like we see in daily up and down in the stock market or in the stock price, which is the stock fluctuations, small up and downs in the stock price. But as per Soros, and also I do agree, is that it would be a great mistake to ignore these biases as mere market noise, like what is stated in the theory of perfect competition and fundamental analysis approach of the security analysis, which is all the theoretical basis for the economy. But if the fundamentals are affected, then the biases cannot be left out without serious distortions, because the bias gives rise to self-reinforcing, self-defeating process that neither leaves the stock price nor the fundamentals nor the participants' views the same as they were before. So these participants' perception about the fundamentals are often flawed, or he says that they are bound to be flawed. This flaw may not be identifiable in the early stages, but is bound to surface later on. So once it surfaces, then it reverses the prevailing bias. If the change in bias reverses the underlying trend, then a self-reinforcing process is set in motion in the opposite direction. So what is this flaw and when it will surface is the key for identifying the boom and bust cycles. So if you see, the behavior of the stock prices is identified by first the unrecognizable trend, then the beginning of the self-reinforcing process, successful test, then the growing conviction of the market participants, resulting in widening divergence between reality and expectations, then the flaw in perceptions, then the climax, then the self-reinforcing process in the opposite direction. So this is how you do a reflexive analysis for a stock or analyzing a market. This is very clear, like what I mentioned in session 73 under the Alchemy of Finance, that the reflexive analysis cannot take the place of fundamental analysis. Fundamental analysis is very much required for identifying the undervalued stock or the potential of the stock. And then once you do that, it is very clear that if somebody is doing some technical analysis, instead of that, I would do a reflexive analysis for that stock, so that I will understand that where the stock is trading now and is it the correct time to enter the stock. So this is like a technical analysis, but more in-depth than technical analysis. Technical analysis use some indicators, but this one directly catches the concept and goes deep into the concept and understands what is the breadth of that stock and where it is going and at what inflection point it is trading. This will help you enter the stock at a reasonable valuation. So combined with our fundamental analysis, if you merge this reflexive analysis, it will really help you enter the stock at a good price and make great profit out of it. So whatever I have explained here, so you can see that on the curve which is on the screen. So the trend, how it is having a fluctuation and how it is reversing and how is having a trend reversal and what are the flaws in the prevailing and underlying biases. All these things are self-explanatory in the curve which is shown here. You can have a glance at that as well, which will help you analyze or have a reflexive analysis on the stock. Hope this session was useful for you. See you in the next video. Till then, happy investing.